All right, so here's what I saw. The strength in the market is because, watch this, y'all. The earnings aren't saying deep recession. The earnings aren't saying deep recession. So right now, 77% of the companies that have reported have beat earnings. 77% of the companies that have reported have beat earnings. And they've beat earnings by 7.2%. Now, here's the crazy part. On average, companies are only beating earnings by 4.7 to 5.2%. So right now, as of Q1, companies are beating earnings at a higher rate and by more expectancies. It's making me think, where's the money coming from? Where's the money coming from? All right, let's go a little further. All right, watch this. So for the Q2 outlook, watch this. Negative pronouncements, we had 35 companies that said, you know what? Here's what we got going on. Positive, we had 27. Just giving guidance on what they see moving forward, which gave us a rate of 1.3. The average ratio is 2.5. What I mean by that is we had so many companies say, yo, this is what we think moving forward. Q2, Q3, Q4. This is the companies that say, yo, we're going to be positive. Q3 to Q4. That ain't scaring the market. That ain't scaring the market. So it's telling me that the market is baking in certain situations. Now, here's what we got to ask ourselves. Here's one thing that I noticed and I want us to pay attention to. Watch this. A lot of companies did something. They lowered their guidance. So even though companies are beating, they lowered. That was the aha. I said, that's it. The companies are lowering the guidance so they can get the beat. But let's go a little further. Also, what's happening? How we getting the beat? Mass layoffs. The mass layoffs are adding to bottom line. Why? Because it's people that I don't have to pay. When it's people that I don't have to pay, that money stays at the bottom. Because it stays at the bottom, it's money I ain't got to spend. That's taken off the balance sheet. Money that's not taken off the balance sheet allows me to do what? Look more profitable. But we're going to dig a little deeper. Let's go a little further, Dave. 2023, the trend. So watch this. Q1, it was rising. Q2 and Q3, it looks a little lower. Q4, we're looking at a steady rate of return. So this tells me this. The market isn't scared of the debt ceiling. The market isn't scared of that. The reason why the market isn't scared of that because in the 20th century, the government has increased the debt ceiling 90 times. In the last 20 years, they've increased it by 16 times. That ain't scaring the market. They understand that. Right now, both parties are just trying to get their way. They're not going to let that go. So, okay, that's not scaring the market. All right, bank failures. What do they know? Okay, banks are collapsing, but guess what? If push comes to shove, Federal Reserve is going to step in. All right, that's not scaring the market. But what is? What is the thing that is keeping the market from running because we are still in a range between 3,800 and 4,200? We talked about that range a couple episodes ago. Why are we still in that range? Something is keeping us here. Something is keeping us here. And it's because I truly don't believe that the market feels comfortable. I don't believe that the market feels comfortable. And where the market doesn't feel comfortable, where the market doesn't see promise, everybody stays in position. We're going to go a little further tonight because we're going to talk about where the money going at. Because I saw where the money going at. I saw where the money going at. All right, let's go a little further there.
What's good, trappers, man? It's your boy, the Wall Street Trapper. Right now, I want to invite you to an amazing experience full of value. That is my community, Trappers Anonymous. It's 100% the greatest fundamental investing community on the market. Listen, your portfolio should be a masterpiece. And the only way we get you there is if we help you to learn how to invest with confidence. Now listen, I get it. Like, you don't know a lot about stocks, or maybe you've heard people say how much money they lost in stocks, but I can guarantee you, one, because they weren't in the community, and two, they lack the information. Our goal in Trappers Anonymous is to help you, really to hold your hand on the journey to becoming a confident investor, learning how to navigate through the different events that the stock market goes through to take you from panic to encouragement. There's no better time than now. This is an opportunity only for those who are willing to be on the journey. So listen, man, click the link below. Come join me in Trappers Anonymous, man. I will see you in one of our many classes, whether it's Moat Monday, whether it's the 2-hour class we do on Sunday, or whether it's just a book club. Everything is geared toward making you a better investor so you can triple your net worth and turn your last name to an asset. It's your boy, Wall Street Trapper. See you in the trap.
Watch this. Earnings on Recession. Here's an update for 2023 right here. The earnings are up 1.53%. Okay, let's talk about this right quick. This is important. Overall, earnings are up 1.5%. Watch this. In a typical recession, earnings are down 10 to 20%. In 08 and 09, earnings were down 50%. In 08 and 09, earnings were down 50%. On average, it's down 10 to 20%. Right now, earnings are up 1.5%. I smell a whole lot of procaine, y'all. I smell a whole lot of procaine. So here's what I want us to understand. Here's what I want us to understand. Y'all know my favorite saying. You don't got to get it right. I just need you to be in position. I need you to be in position because the reason why I like to give y'all these stats is because I don't want to come up here and just be saying, yo, do this, do that, do this. I need to give you a body of work so you can understand. I need to get the goal for Trappin Tuesdays is to help you understand so you can take notes and say, okay, here's what's coming on. Let me go to Trap so he can teach me. Let me go to Trap so I can understand. The reason why we can't effectively dominate the market is because we don't truly understand what's going on in the market. And we don't understand what's going on in the market. How can we function inside of the chaos? The goal for us is to function inside of the chaos. Because it gets chaotic. The market has motion. A lot of it. Okay, a famous investor once said something that I like. In a bear market, stocks go from who loves them to their rightful owners. J.P. Morgan. J.P. Morgan. Essentially, he just said, in a bear market, stocks go to their rightful owners. What does that mean? That means in a bear market, when everybody is panicking, when everybody is selling, because the stock go down $1, because the stock go down $2, because the stock go down $5, everybody is selling. And so because everybody is selling, the rightful owners will take full advantage of the opportunity. Okay, let's go back to the beginning. The opening monologue said what? Confronting poverty. Confronting poverty means confronting the behaviorisms, confronting the ideologies, confronting the philosophies that keep you in the poverty state of mind, the middle class state of mind. Because some of y'all think because y'all got to the middle class, y'all all right. I'm comfortable here. I'm 3 checks above check to check. Got $5,000 in my savings, I'm good. Got $20,000 in my savings, I'm good. Poverty. It may not be to a full extreme, but in the world we live in right now, how far would $20,000 take you? In the economy we're in right now, when the average person has now lost $20,000 of their 401k and withdrew another $30,000 from their 401k for hard times, how far will that money take you? How far will it take you? Confronting. Listen, if you're more than 5 checks, if you ain't a year ahead, you losing. If you was out of work for a year and you ain't had to work, can you do it? So we still thinking minimal. We're still thinking minimal. How far can you go without working? How long can you go without working? How long? How long can we go? That's what I like to talk about. You got to put yourself in a position, my favorite saying, if you allow them to feed you, you give them permission to starve you. At what point do you take somebody else's spoon out of your mouth? At what point? And it's not me talking bad about nobody, nah, but we got to have harsh and real conversations with ourselves, yo. We got to have real conversations with ourselves because remember what I said, once you get opened up to different income opportunities, possibilities, you start to understand the trauma of your old situation. I want us to understand the power in taking advantage of where we are right now. I want us to understand the power and where we are right now. I want us to understand that. All right, let's go to the next one. Here's what I saw. Here's what I saw. The money is leaving the bank fast. The biggest risk for banks is the consumer moving money out of the banks to buy treasuries. This one gonna get deep. This one gonna get deep. So Trap, what is the consumer doing? They're taking the money out the bank to do what? Put it into treasuries. Let's go to the next one. Consumers are they are able right now to get 4% from alternative banking and treasury yields. So that's causing, I told y'all we was gonna talk about where the money was going at. Consumers, people who are in banks, they're taking their money out of the banks and they are putting their money in bonds, treasuries, T-bills. Why? They're doing what's called laddering. They're buying T-bills on different years, and they're able to get 4%, 4%, 4%, 4%, and layer it out because they don't understand how far this is going to go. And what happens is, because they're taking their money out of the banks and putting it in the treasuries, it is now causing scarcity among the banks. I told y'all we're going to talk about it. We're going to talk about it. Jose, come here. I told y'all we're going to talk about it. Why? Why are they moving money out the banks? Because people are scared. People are scared. Because people are scared, they want to take their money out the bank and put it in somewhere where they can get a return. 4%. 4% is better than what? None. 4% is better than nothing. You feel me? So this is doing more harm to the banks than anything. Now, who's it going to affect? The small banks. The small banks. It's going to affect the small banks more than it affects the big banks. Why? Because we're going to get to a point where 4 banks will control 90% of all the money.